Jeff, let me begin with you. I wonder if you can put the last couple of weeks into perspective. We're hovering near our December levels, even though the Fed's pivoted hard, mortgage rates have skyrocketed, and clearly this Ukrainian situation is threatening energy and commodity supply. Why has that happened?
Well, sentiment has shifted a little bit on the conflict. The idea that maybe all the sanctions we're likely to see, at least as they impact businesses in a major way, are maybe now behind us. I think markets are beginning to focus less on the volatility on the geopolitical side and more on the earnings picture as we get closer to the earnings season. So far, we have not seen much in the way of downward revisions. For the most part, global companies are still expecting to see solid earnings growth this year, with maybe positives in energy and material sectors offsetting some of the weakness elsewhere. But, no matter where you look, even in emerging markets, we're looking at expectations for earnings growth this year, not declines. And some markets have actually seen a boost on the higher commodity prices. Areas like Canada, Latin America, a number of those have really seen higher earnings revisions. And I think the market's focusing on that fundamental backdrop more so than the valuation picture.
Yeah. Delano, is that a situation where you want to buy into? You think earnings are going to ratify the bounce we've seen?
Yeah, Carl, I definitely think that that's quite a possibility. So, one area that we've been looking at is obviously the tech sector and the consumer discretionary sector. A lot of that in the past month, what you've seen in the tech sector is momentum. I saw you guys mention on the show that Apple has turned positive for the year, Microsoft has turned positive for the year. A lot of these companies that we saw pull back quite spectacularly over the Ukraine-Russia conflict have started to rebound. A lot of that has been some of that what's happened with the Fed and raising rates and how much is priced in and what the communication has been. And a lot of that has also been, a little bit of that ceasefire talk. So I do think investors could be buying in. You mentioned earlier in the show, volatility index is down under 20 now. And I think investors have come comfortable. A lot of my clients have actually asked, they stopped investing. They were asking, how do we get more back into this situation now that we feel a little bit more comfortable? So I think the sentiment, especially from smaller, younger retail investors, is a little bit more comfortable. I do, kind of wonder where we're at as far as the pace at this rebound, right? You mentioned the S&P 10 days in the green. You look at the pace, some questions about if it's a bear market rally. So you have to be careful, but we do think it's a kind of a positive picture right now, Carl.
Jeff, you apply a global lens when it comes to investing. You just heard that report from Brian Sullivan on what's happening in Europe right now. Is Europe a steer clear for investors until we actually see how all of this continues to shake out?
Well, I'm watching it closely, but so far I've been impressed with the resilience in Europe. Even if you look at Germany, consumers know the challenge to wean themselves off of Russian energy over the next 9 months before we get to the next peak demand season. And yet we're seeing open table dining reservations up in Germany over the last 4 weeks. We're seeing moviegoers, weekend box office numbers are strong. Driving activity, traffic is strong despite higher gas prices. We're not seeing the signs of economic deterioration that maybe consumer sentiment has pointed to. And we're not seeing that in terms of earnings revisions either. So I'm actually relatively favorable on the European outlook, despite the headline risks tied to their dependence on Russian energy.
The part I keep coming back to, Delano, is that if you're an investor focused on fundamentals, the headwinds that everyone was focused on in January and that sort of elicited, at least here in the U.S., the pullback initially, are they not stronger today?
Yeah, I definitely think they are. One of the things that Jeff was mentioning is the consumer sentiment. We do have a strong economy when we're looking at the consumer sentiment. Wages have increased. Employment's down. So those sentiments are stronger today. So that is a bullish sentiment in my mind, that the underlying economy, the underlying fundamentals are stronger. So some of the headwinds that we're seeing that are starting to clear up, this is now a sentiment where you're thinking of if the headwinds are clearing up and we have a stronger underlying economy, you should be looking at situations where you like those certain securities. So they are stronger. We think that it bodes well for a bullish sentiment if you're someone that's dollar cost averaging or buying in this current environment, Morgan.
Certainly a lot of chop. There's no question about that as we look at some of the laggards and gainers this morning. Jeff Delano, we'll talk again soon. Thanks, guys. Appreciate it.